Hey everyone, it's Daniel here from etfs. Hope you're all doing well. Want to do a video on a very interesting article that comes out from the Kansas Fed. And this is dated December 21st, 2022, so last year, December, which is not too long ago. And so the article basically says, have lags in monetary policy transmission shorten. In other words, this article talks about, and Kansas Fed basically argues, that the monetary policy, the tightening that you're seeing in the markets, in the economy, the tightening that we're seeing actually that is having a lag effect, but a lag effect that has been shortened after 2009. So the lag effect that a lot of people are talking about, that monetary policy has a lag effect. And what does that lag effect mean? It means that the data that you see, the results of all the tightening, the raising of interest rates, the balance sheet runoff, etc., 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 that lag pre 2009 was much longer. It was something like 1 year or 3 years for basically inflation to come down. But this article here that comes out again from the Kansas Fed basically argues that the lag effect has shortened, so which basically means that the data that we see shouldn't be too far away from the Fed approaching its goal, from the Fed being late to the party, and basically suggests that the monetary policy that the Fed does is basically closer to almost real time, and the effects of it we get to see much more earlier than previous years, than previously before 2009, when we used to see much more of a lag effect. So I don't know if you truly believe in this or not, but let's go through the article. I'll pull out the article here, and basically, and I'll post the link in the description for you to read up on it. But basically, the first paragraph goes as such: in response to rising inflation, the Federal Open Market Committee, FOMC, tightened monetary policy significantly in 2022, raising the Fed target to 4.25 to 4.5% as of December. Okay, great. We know this already. Nonetheless, inflation has remained persistently high. Many policy makers expect changes in the federal funds rate, the FOMC primarily policy tool, to affect the macro economy with a lag. Okay, so remember that all of this tightening that the Fed has been doing, a lot of people argue that, the Fed is always late, and the reason they're always late is because, the actual effects are happening in terms of the inflation and in terms of the data. The actual effects we get to see from monetary policy, it tends to be very late, and we tend to see the effects later in the years because it takes time for all that tightening to seep into the data to show the real effects. Now, in this article, they say, however, right, to contradict that thought, however, since 2009, the FOMC has employed additional monetary policy tools. Financial markets may react to changes in forward guidance on future path of the federal funds rate and changes in the Federal Reserve balance sheet even before the FOMC changes the federal funds rate, suggesting lags in policy transmission may have shortened since 2009. Okay, so what does that mean? What does that mean? That basically means that they are saying that since the lag effect, since after 2009, post 2009, since their forward guidance, right, that they put out, that's saying that we're going to raise rates to let's say 5.1% like they did in December. Every time they come out and they talk about where they see rates heading in the future, and with the balance sheet tightening, the balance sheet policy that they have that they're doing behind the scenes, other than the rate hikes that you're hearing about and seeing. Because of these two things, this is what's causing the lag effect to shorten. So previously it used to be very long. Now you're expected, or the Kansas Fed argues that that has shortened because before we even increase interest rates, it starts to get priced into the markets that the markets know that since the Fed has told us that rates are going to 5.1%, we bake that into the markets right there and then, and that's what creates the tightening conditions in the equity markets, in the stock market, in the financial markets. You start to create this tightening effect already before the Fed even reaches to 5.1%. And because of this, because with just their simple speech, with just simply coming out and telling you that, hey, we're going to raise rates without even doing anything, they're already conducting their monetary policy without even touching anything. And because of this, this is what creates the shortening of the lag effect. Right? So that's the first paragraph. So with that first paragraph, I do agree that yes, the Fed has very powerful tools. One is the balance sheet, and two is with their forward guidance. When they come out and they say things before even doing it, it has an effect on the markets. It creates a tightening effect, which does create tightening conditions in the financial markets, like we have seen in 2022 with the stock market, with NASDAQ and S&P 500 coming down because of all this information that they're hearing that the Fed is going to raise rates, and continue to push up the bar higher and higher and higher before they even get there. And that's why you see the market selling off. So yes, I do agree that this does have an effect on tightening conditions in the financial markets. Now, if we go through, let's say, the third paragraph here, and it talks about a chart. It says chart 1, and again, click on the link in the description. You can pull up this article and read it with me if you like. But basically it says chart 1 shows the proxy fund rates, which is the green line, has been consistently above the effective federal funds rate, the blue line, during recent tightening episodes like December 2015 to December 2018 and March 2021 to present. So what they're talking about is, I'll show you here. I don't know if you can see it well, but there's two lines. You see the green line and you see the blue line. So those are the two lines that they're talking about. Now keep this picture in mind when I start discussing about these things further, right? So basically, going on in that paragraph, it says the gap between the proxy and the federal funds rate. So the gap between this green line, you see how the green line is higher than the blue line? The blue line is the federal funds rate. This is the rate that the Fed raises interest rates to. The green line is the proxy rate. And the proxy rate is basically taking into consideration that balance sheet tightening that they're doing, plus the forward guidance. So what it is let me finish this paragraph and then explain you what it is. But the paragraph basically says the gap between the proxy and the federal funds rate highlights that the federal funds rate may not capture the full degree of policy tightening in the economy. So that blue line, which is below the green line, right? Green line's above, blue line's below here. This blue line, which is the federal funds rate, it doesn't capture the real tightening, right? What is that real tightening? It's just, the blue line is just them actually raising rates. But the green line, thus, policymakers relying only on measures of federal funds rate may overestimate the lags in policy transmission. In other words, if inflation is responding to the broader stance of policy as captured by the proxy funds rate rather than just the federal funds rate, then lags in transmission from monetary policy stance measured solely by the federal funds rate to inflation may be shorter than what was the case pre-2009. Okay, so let me explain this. What it's basically saying is that the fact that the green line, the proxy, this is the true tightening. And when you look at the green line rates are much higher than the federal funds rate. So the federal funds rate is the actual interest rates that the Fed is doing and that they're hiking, right? So they're around the 4.5% right now. But the proxy rate is way above 4.5%. It's around 6%, 6+%, right? According to this chart 1. And what that is saying is that what the Kansas Fed is saying is that even though we raise rates to 4.5%, it's not considering the forward guidance plus the balance sheet tightening that we're doing, which makes rates actually around plus 6%. And because of this, because rates are actually, if you take the proxy rate, actually around plus 6%, it's tightening more than what the federal funds rate is suggesting. And because of that, people who are calculating that the lag effect, that the monetary policy is going to take a very long time to show in the economy, since there's going to be a big long delay of that, the Fed Kansas is saying that's a wrong way to look at it, because the proxy rate, the true tightening, is actually shortening that delay, is actually shortening that lag, which suggests that data or inflation is actually probably going to come lower and faster very soon because of this proxy rate concept, right? The other chart that they talk about is this one here. It's about inflation. So you can take a look at that. I know I should probably do this in a better way, but I'm not, so bear with me. I could be sharing my screen and showing these charts, but just bear with me for now. So basically, it talks about here in this paragraph, compared with the green lines and the blue lines in chart 2, suggests that the lags in monetary policy transmission have indeed shortened in 2009. In pre-2009, the green lines, an expected 1 percentage point tightening in proxy fund rates reduces inflation and increases the unemployment. However, the peak response of inflation occurs with significant lag of more than 3 years, 12 quarters. So with taking the original pre-2009 kind of thinking, this lag that everyone says, it says that it takes about 3 years for inflation to come down, pre-2009. However, in contrast, now I'm going to read the paragraph again. In contrast, in the post-2009, the blue line, the peak response of inflation is larger and happens after only 4 quarters, suggesting changes in the financial market conditions may affect prices sooner than in pre-2009 period. However, the confidence intervals for post-2009 period, gray shaded area, which measures the degree of uncertainty in the sample, are high, especially when the horizon extends beyond 8 quarters after realization of a shock. The uncertainty associated with this response of unemployment to policy shock is high in the post-2009 period, that it overlaps the pre-2009 estimates. Thus, we don't find statistically significant evidence that the unemployment response has changed. In summary, we find evidence for a shorter lag in period in the peak response of inflation to a policy shock in the post-2009 period, even after we adjust the shock definition to incorporate forward guidance and balance sheet policy. Okay. Our results suggest the peak deceleration in inflation may occur about 1 year after policy tightening. However, the uncertainties associated with the response of inflation is high in post-2009 period. In addition, given high uncertainty, we don't find statistically significant evidence of unemployment response to policy tightening has changed during the recent period. Okay, so basically, to summarize this, they're basically saying here that Inflation, generally, everyone talks about inflation takes about 3 years for it to come down pre 2009. Post 2009, according to this, it's expected now to happen within a year, 4 quarters, right? So within a year, we can see that the policy lag has shortened from 3 years to 1 year, that whatever they're doing in 2022, they expect inflation to basically come down this year, 2023, 1 year, right? So 1 year. So if we take 1 year after all the tightening, if they stop, let's say now, because they're expected to pause anytime soon. So if you expect them to pause anytime soon, we expect closer to the end of 2023, we will see inflation come down. Now, here's the catch. If the Fed is suggesting that the policy lag is expected to shorten, and inflation does not come down, this is where I can see that if they believe, according to this report, that inflation is supposed to come down and the lag has shortened, and hey, don't worry, everything will be fine, then that tells me that they can be really, really aggressive, which may suggest to me that, hey, if inflation doesn't come down and they continue to hike rates, there is a very high probability chance that they will create a policy error, they will over tighten, they will break something, which will eventually cause inflation to completely collapse, according to this. Because I'm still on the boat and still believing that the lag effect is still going to take time. Although, yes, they have tightened very fast, they have increased rates very quickly, but their proxy rate that they talk about, I mean, we'll see this year what happens, but the proxy rate that they talk about that's saying that is shortening the lag, I don't think it really is. And I think this article is more of an excuse to say that, hey, don't worry, we're not late to the party. And hey, they want to make sure that they have some credibility and say that, hey, we're not doing anything wrong. Look at the proxy rate. Look at how we calculate things. And we're actually going to see the inflation come down sooner than expected. But if they're wrong, which again, I'm leaning towards that, I don't think the proxy rate, and I don't think that I believe we're still going to see a policy lag, and it's going to take its effect. And I'm not really on the camp that even if inflation comes down in the next couple of months, I don't think it's going to come down so significantly that's going to cause the Fed to completely flip. Even if it does come down, they're still going to head towards raising rates aggressively, which means that if inflation is not coming down as expected, and they said that the lag has shortened, then if the lag has shortened and inflation is higher, then that basically means that they got to raise rates more and they got to tighten more, which is basically the recipe for disaster, because they're saying, hey, it's supposed to come sooner, but hey, also it's not coming down. So raise rates aggressively. Policy rates are suggesting 6-7%, and Fed funds rates around 4%. Maybe we need to reach the Fed funds rate to that 6% levels, or 6.5% or 7% level, to get people to start thinking that inflation is coming down, and then that's where I think the over tightening will happen. And then you will see that, okay, something has broken. They made a policy error. The inflation and the data, the unemployment rate skyrockets. The data, the growth really gets weak. And then finally, yes, inflation comes down because they're saying, hey, the lag effect is not really there. We will see inflation lower, but since it's not lower, we continue with higher rates for longer, and thus causing the break in something in the economy that does, yes, bring inflation lower. So very interesting article. take a look at it. It's in the description for you, and read up on it. Let me know what your thoughts are. Don't forget to like, share, comment, and subscribe if you like content like this. We talk about macroeconomics, the economy, trading, and whatnot. My views, everything real time as the markets go on, as new information. As we get new information, I'll comment on a few things. But I thought this article from the Kansas Fed was pretty interesting. So take a look. Let me know what you think, and I'll see you guys around. Cheers. Bye.